about why I'm okay with a 5% distribution rate when it comes to retirement. And so I'm going to use this Vanguard retirement nest egg calculator, which I actually like quite a bit. Real easy to use. I'm not sure. Let's see if I can't share a link with you in the show notes, but I like it quite a bit, as a matter of fact. So let's go over this because I think it's fun. So basically, there's we know about the 4% rule, which I've talked about a million times on Sunday. Just I guess real quickly. So remember, the 4% rule says you're going to take 4% from your portfolio each and every year, adjusted with inflation, and that will last you for essentially the entirety of your retirement. The drawback about the 4% rule is it was done in 1994, I think. It was based on those markets from 1926 to essentially 1990 or something like that. So it's been almost 30 years since that was derived. Lots have changed, and particularly the fact that bond rates that were historically 5.5% to 6% are half of that. All right. So that's the drawback with the 4% rule, which would lead you to believe that then it's actually a 3% rule because our yields have gone down. And I actually agree with that. If you're looking at the 4% rule, you don't need you should look at a 3. I think, what's his name? It's Kitsis, Blanchett. I can't remember one of those guys. Fowl. I forgot. But they had written about 3.2% rule, which I actually subscribe to. If you're going to look at a 4% rule from the previous era with interest rates being 5.5 to 6, you really need to back that down to about 3.2. The problem I have with that from the entirety is that assumes they're going to spend each and every year with inflation, not just increasing. And it's just simply there's no validity to that. It doesn't mean it's not as bad to shoot for, but just at the end of the day, what I have found and what we can pretty much attest to is that most people spend less in retirement. That's just all there is to it. So the 4% rule is premised on this kind of spending when in actuality it goes the other way. So now you're getting a widening chasm of divergence between reality and then what the 4% rule says. So I say, look, start with 5%. I'm completely okay with that. You're going to have to do some belt tightening if the markets go south, but just start with 5%. So now Vanguard has this retirement nest egg, which I thought would be pretty neat. And it says, it's easy. And I love it. I love it a lot, as a matter of fact. It says, we're going to run, you can do whatever you want here. So I'm going to say, I want to live, I'm 65 now. I want to live till I'm 95. I want my $250,000 to last for 30 years. All right. And I'm going to take 6% a year off the portfolio, 6% a year off the portfolio. Now, how my savings are allocated, well, that's it right there. I have no bonds. I got 80% in stocks and 20% cash. And I want to run the simulation. So watch this. This is pretty cool. Now, there's method to my madness here, my friends. All right. So we have a 60 probability that savings will last all 30 years is 61%. So I'm pretty comfortable with that probability. If we go to 35 years, it'll be over 50% still. Yeah, about 56%. Let's see. Does it tell us? I don't know if I can slide that. Can I slide that? I guess I can't slide that. All right, anyway. So you can see 50 years it'll last, was that about, around about 48% or something like that. Projected, that's how long it'll last. Projected savings balance, this is hard to figure out. And the percent of projected results within 50% of the time I'd have 1.8 million. I can't figure that one out. That's a tough one to figure out. Percent of projected results. The dark one is 50% of the time. So 50% of the time I'd have over 1.8 million and 50% of the time I have less than 1.8 million. I can't figure that one out. But anyway, it doesn't matter. So let me go to explain this chart. So that looks pretty good. You might be saying, why don't you have any bonds in there, Josh? Well, let's go back to this guy here. And I'm going to go to blank. Let's go 60-40 stock to bond and see what we got. Run simulation with 60-40 stock to bond or stock to cash. And there's still a 50% chance. So by increasing my cash to 40% from 60%, I still have a 1 in 2 chance of having money left over. I don't know how to figure this one out. That looks kind of odd to me. I don't know what to make of this one. So anyway, I'm going to stop trying to explain that because I can't. So now let's talk about this. Let's explain this chart. All right. Okay. Well, right here for stock market returns. I wonder if I'm going to make that bigger. Hold on just a second. How do I make that bigger? Go to Zoom. There we go. One more. For stock market returns, we use the Standard & Poor's S&P 500 from 1926 to 1970, Wilshire 5000 from 1970 through 2005, and the MSCI U.S. Broad Market Index thereafter. For bond market returns, we use the S&P 500 high grade, blah, blah, blah. And then for the returns on short-term reserves, i.e. cash, we use the Citigroup 3-month Treasury bill. For inflation, we use the changes in the annual CPI. All right. The point about this is I am eliminating the false interest rate that you've been getting from bonds, from bond returns from 1926 and through the end of basically 2018, because they're using the U.S. Barclays U.S. Aggregate Bond Index essentially for the entirety, whatever indexes are. But they're using the average bond yields historically. And I don't want to do that because, again, the average bond yields has been about 6.5. I'd rather use a 3-month Treasury bill as a more of a safe arbiter, if you will, of the assumptions for a bond-like portfolio. Does that make sense? So I'm getting out, I'm underselling the interest rates that bonds could show you because I don't believe them. I don't believe the historical bond rates will ever come back. And because of that, we're looking at 3% on the 10-year Treasury. Well, actually, that's not true. Right now, it's 3% on the 30-year Treasury. And I think you got to look at bonds between 3 and 4%. And if you look at the historical average, it's about 5.5 to 6. So I'm using cash, and that may or may be reflected, probably will, in the 3-month Treasury bill historically. So I'm comfortable with that. So essentially, we're getting out of bonds, we're using cash, but the cash interest rates in this portfolio tool are similar to the bond interest rates that are out there today, if that makes sense. For each year of simulation, we randomly select 1 year of stock, bond, and cash returns from our database. Using those values, we calculate what would happen to your savings, subtracting your spending, adjusting for inflation. And again, they're using the CPI, Consumer Price Index, from 1926 through last year. We repeat this process 1 year at a time until the end of your retirement or your savings are exhausted. The next simulation starts the whole process from the beginning. We're using 100,000 independent simulations. We tested a broad range of possible scenarios, and clear patterns begin to emerge. By keeping track of the number of simulations in which your savings last for a certain period of time, we're able to estimate the probability that your plan will be successful. For example, if your balance is greater than 0 after 30 years and 80,000 of 100,000 simulations, we can estimate that the probability of success is $800,000. Of course, it's 80%, is 80%. Of course, it's important to remember that Monte Carlo simulation assumes the future will at least be somewhat like the past. After all, we are using historical data in each simulation. In actuality, the future may contain scenarios that are better or worse. Okay. I 100% agree with that, which is why I'm getting rid of the bonds. All right, so that's 60-40. We're taking 6% a year out of a $250,000 portfolio. That's $50,000 a year. We're running 100,000 simulations, and 50,000 times do we have money left over. And I wish I could figure out what this meant here. I guess it means in the 50% range. We ran out of money 50% of the time. We had 400. Let's see. 50%, we had 400,000, looks like about 700,000 on the best, obviously 0 on the worst. I guess that's, I want to say close to median of 400,000. But we had a range of 0 to roughly $750,000 on the 50% range. So we had a significant amount of money potentially left under this scenario right here. And that's a 6% distribution rate. And that's a 40% bond. So let's go to say 40% cash, essentially. Let's go to say we're going to do 30%. What I want, right? 30% right there. And I don't want any bonds. We're going to do 70-30. And this is more to my liking here. Again, 6%. What's the probability? I got to go back to this guy. 57%. Again, that's for 30 years. 57% with 70% stocks, 30% cash. I like that quite a bit, as a matter of fact. I'm a big fan of that. I think that looks pretty good to me. What if you did? I'm never going to do 100% stocks. But let's say we did, 5% as opposed to 6%. Or we'll just do 5.5. Oops, can you give me 5.5? It's got to be in increments of 1,000. All right, so we'll just say 5.6. And we got 70% stocks, 30% cash. What does it give us here? Sure, it's going to be better. Yep. Let's see. What was it? 57% last time? 64%. Now, again, remember that assumes we're taking 5.6% a year each and every year, adjusted for inflation, which is a CPI, roughly 3% a year. And even that scenario, man, 100,000 times we run it, 64,000 times we had money left over. Now, some people say I need to get that 85% or more. And I don't get that. I don't understand. I mean, I get it because it makes you feel safe, but I think you're making a mistake. The mistake that you're making is that you're saying I'm going to under consume on the front end, so that way I have more to consume on the back end. When the back end of your retirement is when you're not going to want to consume as much to begin with. So I'm a big fan of this. I love this. It's simple, it's easy, it's to the point. We're using the average indexes on stocks and bonds, and not bonds, and cash. I mean, it's bonds too, but I'm a big fan of this. I'll put in the show notes because the Vanguard Retirement Nest Egg Calculator, I love it. I think it's fantastic. Give you a starting point of what you could think you could run. I'll just read the Monte Carlo simulation. Planning for your retirement would be easy if you could depend on earning the same amount year after year from your savings. You'd know exactly how much you could afford to withdraw and would never have to deal with market uncertainties. Let's take a sample. You start with $1 million and you're planning to live on $75,000 per year, adjusting for inflation. Again, $75,000 per year, each and every year is your expenditure. Let's assume that's 1973 and your savings are invested in an index fund that tracks the S&P 500. With the benefit of hindsight, we know this index earned an average of 12%, so we'll use that figure in our calculations. The graph above shows the results of your 30-year retirement. Your portfolio earned more than you spent. If this happened to you, you might include that spending $75,000 was too conservative. But now let's look at this a little bit differently. Assuming a consistent 12% annual return, let's use the actual historical results from the last 30 years, 1973 to 2002, which vary from negative 26.5 to 37.5% up. And you can see here, as you can see, your portfolio ran out of money after only 16 years. That's the sequence of return risk. Well, why? Well, it happens that 1973 and 1974 were down years, 14.66 and 26.47 respectively, and your savings were unable to recover from that early decline. While subsequent years brought you up to an average back at 12%, you didn't have enough savings left to benefit. Here's a third example in this case. Instead of 1973 to 2002, let's assume your retirement span the years 1954 to 1983. Coincidentally, the average return of the S&P 500 of those 30 years was also 12%. So we might expect similar results. However, the chart shows us surprising news. After 30 years, your portfolio is worth more than $8 million. That's because 1954 and 55 were remarkable years with annual returns of 52.6 and 31.6 respectively. With that extra money in your account at the beginning of your retirement, you're easily able to weather the storms of 1973 and 1974. Monte Carlo gives you a more realistic assessment on how the future may unfold by looking at a wide variety of potential market scenarios that take fluctuating returns into account. Instead of basic calculations on just one average rate of return, we generate 100,000 simulations of hypothetical market scenarios and calculate the impact on your savings during each retirement. How does it work? For stock market returns, I'll let you, we just talked about that. So there's a simulation. We're doing all of these 100,000 independent ones, a broad range of samples, and it's awesome. That's the best thing we have. Will it be right? No, it's not going to be right because we have no clue what the returns are going to be. But it's the best thing we have in terms of assumptions you can make about going forward. But you got to make the assumptions based on, you got to watch out for the bonds. Now, people say, well, the stocks are assuming a high level of returns too. Well, are they? Because don't forget, explain this chart. We're going to show you the stock market. Well, they're just using broad market index, U.S. Morningstar Capital Index. So they're not Morningstar, Morgan Stanley Capital. So they are using domestic stocks. That might be a little bit too high too on stocks. In that case, you might want to tap that down about 60 and say your cash is more likely than that. So use a 60-40 stock to cash portfolio. I'd be more comfortable with that because that way you're not getting some of the benefits of high stock returns historically. You're actually putting a ceiling to some degree on the upside of this 40%, which won't be much. So I'm comfortable with that for sure. But either way, That's why I use the 5%, because I think it's very justified to say you're not going to spend 4%, 5% each and every year increase of inflation. You're going to spend less as you age. And because of that, I think you can gamble a little bit on a little bit more consumption on the front end of your retirement and enjoy it, man. Enjoy it. You only live once. All right. Hope this helps. I'll put a link in the show notes. Don't forget to subscribe, share. I'd love to hear your comments. If you have a different calculator, I'd love to see that for sure. And just let me know. All right. Thanks, guys.